Hi everyone, Tony here from the Mortgage Agency. Today I want to talk to you about how borrowing under a trust would increase your borrowing capacity. So what is a trust? As noted by Jamie from JMK Partners, a trust is a relationship where a person or an entity, the trustee, looks after assets for the benefit of the trust beneficiaries. Put very simply, a trust is just a structure that is capable of running a business and investing in assets. It has a different set of rules when it comes to taxation. For investing specifically, it can be a fantastic structure to hold property. It has access to the 50% capital gains discount, as you would if you held the property individually or with someone else. You will need to be aware of potential cons, such as land tax implications. So, when would you actually use a trust for lending and help boost borrowing capacity? Let's say you have a lot of cash stored up, but you want to keep building an investment portfolio. However, it's your borrowing capacity under your individual name that is restricting you from obtaining any more lending. This is because your income only supports a certain level of debt. So, to get more lending, either your income has to be increased, your rental yield has to be significantly higher than your interest rate, or you'll have to pay down your existing debts significantly. Now, what if I told you there is a handful of lenders out there in the market that is able to lend you more when you purchase a new property under a new trust every time? But first, let's talk about how banks assess debts. Majority of lenders will assess your serviceability based on debts such as personal debts, regardless if it's home loan, personal loan, or credit cards, debts within your business, or debts that you're a guarantor of. Regardless if these debts are in different entities, the lenders will take into consideration of all these debts into the calculations. When is it a good time to use a trust? A good time to use a trust structure is when your goal is to purchase more properties and also having plenty of cash in your bank account. But the problem is your borrowing capacity. For example, let's say your borrowing capacity is $400,000 with any bank at any given time. Now, after this $400,000 loan, you've essentially reached your borrowing limit to get any more additional loans. But you still have a lot of cash in the bank account and want to keep investing in properties. This is when borrowing under different trusts actually helps you accumulate more properties. Let's say I purchased a property under property trust number 1 with a loan of $400,000. So technically, with most lenders, I am capped with my borrowing power. However, as mentioned, there is a handful of lenders out there on the market where if I purchased a new property under a new trust, let's call it property trust number 2, with a loan of $400,000, they will not include the debt from property trust number 1. And so on. If I purchased a new property under trust number 3, the debt from property trust number 1 and number 2 will not be included into the calculations under property trust number 3. This is because these lenders consider different trusts as a different entity. Therefore, borrowing under a trust structure allows you to borrow more and more with different trust entities. If you are considering borrowing under a trust, it is highly recommended that you talk to your accountant before doing so, or call Jamie from JMK Partners. I hope you learned something new today, and we hope to hear from you soon.